So for the first time in 30 years, gold crossed $5,000 and the dollar hit a multi-month low. And central banks made their largest gold purchase in decades. So most people think gold is moving because investors are scared. That's only half the story. So what's really happening is far more interesting, and it starts not with gold but with trust. So over the last few years, the global financial system has been running on assumptions that rarely get questioned. Governments issue debt, central banks hold that debt, and market assume stability. But when those assumptions start to crack, behavior changes quietly at first and then all at once. So in 2025, the world was hit with overlapping shocks, geopolitical tension intensified, and energy routes were questioned. So supply chains that were supposed to be resilient proved fragile again. And every time conflict flared, the same pattern repeated. Volatility rose, currencies weakened, and the cost of protection went up, that is gold. And that environment matters because it shapes how central banks think. Unlike traders, central banks don't chase returns, they manage survival. And survival means reducing exposure to anything that depends on political goodwill or long term promises. So by late 2025, gold prices had already surged past levels many thought were unrealistic, briefly touching $4,500 an ounce, marking a gain of more than 70% in a single year. Then something unusual happened. Prices didn't fall back. As 2026 began, gold didn't behave like a speculative trade. It behaved like an asset being absorbed, and eventually it crossed $5,000 per ounce. At the same time, the US dollar was moving in the opposite direction, sliding to multi-month lows. And that combination set off a chain reaction. As the dollar weakened, the valuation maths shifted. The global stock of official gold reserves climbed toward $4 trillion, while the value of foreign held US government debt stalled around $3.9 trillion, and that's when a historic line was crossed. And for the first time in about 30 years, central banks collectively held more gold by value than US treasuries. And this wasn't about speculation, it was about repositioning, and it explains why central banks become such aggressive buyers. In 2025 alone, they added more than 1100 tons of gold to their vaults, one of the largest annual purchases on record. Much of that buying came from emerging economies that had been watching global events closely and drawing uncomfortable conclusions. So countries like China, India, Turkey, and Qatar didn't suddenly fall in love with gold. They responded to risk. Inflation risk, currency risk, sanction risk, and gold offered something no financial instrument could. No counterparty, no promises. Meanwhile, confidence in traditional safety anchors was being tested. The US national debt pushed beyond $38 trillion. Political battles over budgets and debt ceilings became routine. Trade policy shifted without warning. Even large European pension funds publicly disclosed reduction in US Treasury exposure and citing long-term uncertainty. Those were not emotional decisions, they were institutional ones. Geopolitical pressure only reinforced the trend, and tension between Israel and Iran resurfaced. US naval assets, including the USS Lincoln, moved closer to the Persian Gulf. High-profile political actions involving Venezuela added to the sense that financial stability could be influenced by geopolitical decisions at any point. In that environment, central banks didn't ask what pays the most, they asked what can't be frozen. And that's where gold stands alone. It's physical, it's universally recognized, and it exists outside digital or political control. Even now, this doesn't mean the US dollar is finished. It still dominates global reserves, accounting for roughly 45 to 58% of foreign exchange holdings, but something subtle has changed. Countries are no longer comfortable relying on a single system. Local currencies are being used more often in trade, especially across the global south. Reserve strategies are being diversified, and this isn't a collapse, it's a slow withdrawal of blind faith, and that shift has consequences. So lower structural demand for US debt affects bond market. Currency fragmentation increases volatility, and investors begin to rethink what safe actually means. For central banks, the conclusion is clear. Diversification isn't a choice anymore, it's a requirement. So, as 2026 unfolds, the forces that pushed gold higher, debt, geopolitics, and uncertainty remain unresolved. Gold's rise isn't the headline, it's the signal, and the signal is telling us that the global financial system is quietly adjusting to a new reality, one where trust is spread thinner, risk is managed differently, and safety is being redefined in real time. Now that we understand why central banks bought more than 1100 tons of gold in a single year, the bigger question is this: what does it actually change? Because when central banks move, they don't just influence the market, they quietly reshape the rules of the financial system. And let's start with the US dollar. Despite all the headlines, the dollar is still the world's dominant reserve currency. And according to IMF reserve data, it currently represents roughly 45 to 58% of global foreign exchange reserves, depending on how you measure it. And that's a massive lead. So no, the dollar is not collapsing, but here's the key point that most people miss. For the first time in decades, the direction of travel has changed. The dollar share has been gradually declining, while gold share has risen to around 25 to 26% of global official reserves, the highest level ever recorded. And that shift didn't happen because gold suddenly became productive, it happened because risk changed. Now let's talk about US debt because this is where the numbers really matter. So as of late 2025, the US national debt crossed $38 trillion according to Treasury data. Interest costs alone are now measured in hundreds of billions of dollars per year. And that means the system depends heavily on strong and continuous demand for US treasuries. And for decades, that demand was almost automatic. Foreign governments recycled trade surpluses into US debt, and central banks treated treasuries as risk free. Large institutions barely questioned the assumption. But in 2025, something subtle happened. Several European pension funds publicly disclosed reductions in their US Treasury exposure, citing political instability and long-term fiscal uncertainty. At the same time, emerging market central banks accelerated gold purchases instead of increasing bond holdings, and that matters very much because even a small reduction in structural demand for US debt can have outsized effects on yields over time. Higher yields don't cause instant collapse, but they do raise borrowing costs, limit fiscal flexibility, and make deficits harder to manage. And now let's zoom out. Why are central banks acting this way? So geopolitics is a major driver. Throughout 2025 and into 2026, tensions in the Middle East intensified, conflicts involving Israel and Iran resurfaced, threats to major energy corridor raised concern about oil supply and inflation. At the same time, US military assets including the USS Abraham Lincoln carrier strike group moved closer to the Persian Gulf, signaling elevated geopolitical risk. And market react to this kind of uncertainty, but central banks prepare for it. Add to that the precedent set over the last few years, where foreign reserves were frozen, restricted, or weaponized through sanctions, and the incentive becomes clear. Gold cannot be frozen, gold has no issuer, gold doesn't rely on political alignment. And that's why central banks view it differently from bonds or currencies. And this doesn't mean gold replaces everything. Even today, central banks still hold a large amount of US dollars, euros, and government bonds. But what's changed is concentration risk. Instead of relying heavily on one system, they are spreading exposure across assets that behave differently under stress. And another important trend reinforces this shift. More countries are settling trade using local currencies, particularly across Asia, the Middle East, and parts of the global south. And that reduces the need to hold massive dollar reserves simply to facilitate trade. And again, this isn't dramatic, it's incremental. But systems change through increments, not headlines. So, what does all of this mean going forward? First, global demand for US treasuries may become less automatic. Second, currency markets may experience higher volatility as reserve strategies diversify. And third, assets perceived as long term stores of value may retain a structural bid even during markets pullbacks. And for central banks, the message is already clear. Risk management now means diversification over concentration, and liquidity over yield, and resilience over optimization. As 2026 unfolds, the driver behind the gold surge, geopolitical friction, high debt level, and persistent uncertainty, gold rise isn't about fear, it's about preparation. And when institutions that plan decades ahead starts preparing differently, it's a signal worth paying attention to. Not because it tells you what to buy, but because it tells you how the world's financial architecture is quietly being redesigned.